Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
All right, good morning, everyone. It is the McNichol & Associates research meeting for, is it here, March the 12th. So I did a fairly detailed call with Cash Today, our other kind of subprime private lender, and goeasy's been kind of all over the news. So we'll just sort of compare and contrast the differences between, a company essentially owned by public market shareholders and a company owned by a more or less a family. The disclaimer per usual is just drawing your attention to the fact that we're not recommending you buy or sell any of the securities described here today. So as most people on today's call know, we've been long-term investors in this company, Cash Today, based out of Edmonton, Alberta, and now kind of growing out nationally. The specific investment that we have is a series of debentures. They are secured, and so very pleased with that. But with sort of the the very visible fall that goeasy experienced, one of the things that actually Cash Today did was they proactively so Grant Patterson, the essentially the CFO, approached me and said, I want to talk to you about kind of what's going on with goeasy and how we're different. And the main three differences that, I got out of my call with the Cash Today, leadership team is, number one, it is the case that it's a privately owned business and the family is still a sizable shareholder. And so sometimes with publicly traded companies, really the goal for the CEO is to, just sort of expand. As most of us know, goeasy acquired LendCare in 2021 for about $320 million. And it looks like not shortly thereafter, there was some problems, particularly on three areas. Number one is LTVs. So Cash Today really, in terms of loan to value, they lend you about a third of the money versus your assets. So there's a bit of margin of error there, predominantly for depreciation. And so some of these electric scooters that, goeasy seems to have gotten in trouble with through its LendCare division pertain to the fact that, really with these scooters, by far the most, expensive component is going to be the battery. And anybody who's, taken a physics course knows that with batteries, unfortunately, after you start using them, each time you recharge them, it is the case that it's slightly less. So that's number one, LTV. Number two, the definitions of delinquency between Cash Today and goeasy could not be more different. I didn't actually know this. I thought it was on day 35, but on day one, actually, they have all of their clients closely monitored, and the assets actually have GPS tracking devices in them, which I was kind of surprised more people don't do it. I can't imagine a GPS tracker to be that expensive these days. So, a pretty good peace of mind investment. But on literally on day one, Cash Today basically swarms you and says, you missed this payment. Why don't you go ahead and come in and talk to us about how we can get you back on side? And by day 35, if a resolution has not been reached, they kind of mark you as delinquent. What was happening with goeasy is not only did they start off at a position where, their definition of delinquent was 90 days, they actually extended it to 180 days. And this is now under, I guess, scrutiny. I noticed there's some law firms moving in. But I would sort of wonder, if I was an Ernst & Young audit partner right now, What could be going through your head to sign off on that decision? I don't know. I don't come from an audit background, but essentially you're giving people that had a 90-day lead of fleecing you. Now, you're giving them a full 6 months. And so this brings me to the third part of the difference between the two companies is really the issue of security, but mainly collections. So the Cash Today leadership team, all of them, uh, they're very good at making these title loans, but their real expertise, as I found, is in the collections area. And as I understand it, with Go Easy, some of the agents in the field, the bailiffs and the collections guys, have been corresponding. Now, this isn't official. I just sort of heard this, so I don't know, what to make of it. But in the case of Go Easy, it would appear that in addition to concealing or suppressing charge-offs or essentially delinquent loans that should be charge-offs, meaning there's no possible way of ever recuperating the money, attempts to actually recuperate it have not even been made in cases where the borrower had the money in their account. So there's a bit of an execution and administration problem. And so that's basically the difference here. And so, we're going to continue on with our Cash Today investment. They'll have a full-blown update in May of their 2025 results. And just this morning, we got an email from one of our planning partners about, private credit. And so just be advised, if you're making these private credit investments, there's three things: LTV, the definition of what, is delinquent and who's monitoring that, and the collateral valuation, who's doing all of that. And then very importantly, collections, because if it costs you, $3,000 to collect on a $5,000 debt on an e-scooter, that's a big number. And, there's an execution and administration issue there. So it's complicated. You gotta stay on top of it. So that's it for that. So let's move to charts of the week. Pretty obvious transition of the market here, moving from kind of hanging out in that overbought region for several weeks at a time to now maybe spending more of its time in the last couple of sessions just underneath that 50-day moving average. It's certainly not the worst thing in the world, but it is quite a bit different from what we saw earlier in the year. Wednesday was a relatively boring day, as Andrew says, compared to other days, and the S&P 500, kind of got out of breath right around that 6,800 point region, and it sort of needs to kind of muscle through that zone. These two, a confluence of trend lines to, be able to show investors that it does still have some firepower left to get above that level. Otherwise, Andrew figures we can assume that this is sort of a zone of resistance, which could mean lower prices. One of the data points he highlights in this week's report is that December low. The index did come pretty close to dipping or cracking down through that December low on a closing basis this past Monday, but it did sort of ricochet or bounce back from that. So for the time being, it looks like that's going to hold. This is a crude oil chart. It's very, very interesting for a couple of reasons. First, the volatility here has been remarkable. And I think the other thing too you have to think about in terms of oil, it is probably biased to the upside because the US government, I believe, indicated that they're going to initiate activities aimed at, tapping into that strategic petroleum reserve. That had absolutely zero impact on oil prices. In fact, oil prices, went up after the correction here. I believe it sold off about 35% from cracking 100 plus bucks. This is WTI, by the way, not Brent. So the second thing that did not move oil a lot is, I believe, President Trump indicated he may have his military or Navy escort ships through the Strait of Hormuz. And that also did absolutely nothing to oil prices. And so, if you're an oil and gas type of investor, looks like there still is a case to be made for the bullish side of oil. Now, we're not, $200 a barrel type people over here, but looks like there still could be some money to be made here. In terms of his risk on, risk off indicator, it is now, for the first time in certainly a while, into that risk off type of box. So the red box at the upper right hand side, and then also looking at small caps. So small caps, I think we've had sort of a mixed relationship with small caps. Where we did redeem a pretty good chunk of our small cap exposure out of the absolute return fund. And if you take a look at the upper, again, right hand quadrant of this chart, we hit approximately the January and February 26 NAVs for our small cap positions. And so looks like we got out at a decent level, but they are coming back down. And so we missed part of that, leaving a little bit of money on the table. But from a sort of overall perspective, with small caps now cracking down through that lower, I think these are the Bollinger Bands or some sort of variance lines, potentially a buying opportunity. I don't know that this would be sort of our wheelhouse to dive back into small caps after kind of lightening the load a bit, so to speak. But it is so a lot of comparisons between the gold and oil ratio. This is just sort of a technical. I mean, this is sort of, I would say, from more the folklore part of technical analysis, if I could be so blunt. But you are seeing sort of a technical case here where oil could go higher, just in terms of the fact of its ratio to gold. And of course, silver is another commodity that could do that. And I think that's it for myself this week. So I will pass it back to the team. Thank you.
Thanks, Joe. Ken, are you ready to go there?
Yep.
Okay, go for it.
Sorry. Okay, you guys can see that, correct? Cool. Yeah, March 12th, typical weekly report. Canadian disclaimer first off, and then followed by the U.S. disclaimer, just not offering securities advice. Contact us via email or through our website to learn more about our investment process and if you have any questions. Just quickly flipping through here, S&P 500, $1 increase week over week. It did have a $3 reversal this week after creating that sell signal. Continuing to see this cyclical sell-off, I'd say. Over the last week, obviously the strongest sector, energy. Second strongest sector, interesting enough, has been semiconductors. So I'd say cyclical sell-off X semiconductors recently. But in terms of the technicals, we're really seeing a breakdown here. Like I said, sell signal, that's the first since the November. Price objective reversed last week. Current momentum very negative on the weekly and monthly. Third week in a row, it's been oversold for the last 5 weeks. Really turning over here from I'd say a really strong technical outlook for the U.S. indices to a bit of a weaker outlook where we've been running flat since basically October or maybe even September, depending on when you track it. NASDAQ, kind of same thing, 2 column changes, ended up at the same spot it was last week, but it did continue to bounce off this short-term support. So perhaps that's a line to watch, 24,400. We'll be watching it very closely because if it does reverse here, it could create 3 straight sell signals. That'd be the first time since this sell-off back in spring last year from the implementation of the tariffs. Predating that, it was 2022, the last time the NASDAQ 100 had 3 straight sell signals. Technicals continue to break down as well for the NASDAQ. Below the 50-day moving average, it's approaching within fractions of percentages. The 200-day moving average momentum turned over. Obviously, over the last few weeks, this is the longest negative weekly momentum since last spring. The overbought, oversold 6 straight week. It's been oversold. That's also the longest streak since last spring when it was oversold 9 weeks in a row. And then the fundamentals. NASDAQ 100 still trading at an elevated level in terms of earnings. So really not flashing in terms of fundamentals or technicals. Looking at the Dow here, $8 decrease week over week, new sell signal this week, second straight. That's the first time since last spring as well. It did drop below a couple strong support lines up here and created this support line closer to the trend line, so something to watch there. Funny enough, when I was just analyzing the companies, I just had the scatter plot for the Dow, and I looked over the last week as of yesterday, their performance, and only 2 out of the 30 were up over the last 5 days. So kind of an interesting carrot there. Some really seeming to break down. On the monthly, we got a flip this month, obviously. Price objective turned bearish. It is below the 50 and 200-day moving average. 59% oversold this week. That's the lowest since last April 18th, and the second straight week it's been heavily oversold. Obviously, in terms of valuation, still a lot more attractive than its 2 U.S. counterparts, but technicals really breaking down for these U.S. indices. Going over to Canada, looks a little stronger. It did create a sell signal for the first time since November. Target price reversed as well. Current momentum for March did reverse as well. It's down week over week. It's been kind of trading in this little range, I'd call it, for a number of months now. It's obviously cheaper in terms of fundamental valuation. The only positive I will say with all this rockiness and instability and volatility in the markets, TSX still overbought this week. I'd say that's probably because of its energy exposure, but 4% overbought. That's the lowest in 5 weeks. But despite the U.S. sell-off, we'll call it, on the technical charts, the Canadian still seeing some inflows, still seeing some of that relative strength that we've mentioned in the last couple of, last couple of quarters, maybe going on a year and a half now. Looking at the VIX here, obviously we peaked up at about 35%. We continue this trend upward after you can see these 2 little blue dots which match these trend lines. This indicates a negative trend. The red dots indicate a positive trend. We're back to a positive trend after just a week where we saw a breakdown below the trend line. But the overall trend continues upward. It paints a picture of close to 50%. Obviously, that's just a pure technical data point, no fundamentals in that. And then it's created 2 straight buy signals. You can see basically since the bottom, 9 of the 10 signals that it's created, the VIX has created this year, have been buy signals, so an increase in the overall trend. It would be interesting to go back on Dorsey Wright's data to see the last time 9 out of 10 happened in a sequence to see where the VIX went after that, but I don't know if I'd have that data set. Looking here, just like I said, the U.S. indices continue to breaking down on these technical charts. Bullish percentage, large caps and the whole universe moving lower. Large caps moving to their lowest point since, I guess, late last year, just a few months ago. Same with the NYSE. Looking at the percent positive trend, the Dow plunges on the amount of companies trending in a positive manner. I did mention only 2 out of the 30 of the Dow 30 were up over the last 5 days. So I'd assume that a lot of companies within the Dow are trading near or close to their trend lines where they can flip back and forth positive, negative. So something to watch there very closely. And then the Toronto Stock Exchange also kind of turned over right here with the bullish percentage, flipping over 6% to its lowest in 6 months. That's something to watch because we've seen some really nice sustained strength for the TSX on all their technical charts, but this is the first time we've seen a real strong turnover. If we do create a sell signal, it will be something we'll be watching very closely on those charts. I'm looking here, asset class rankings. Surprisingly, domestic equities actually gained buy signals, but it did drop a position in terms of the overall buy signals amongst the broader asset classes. Commodities jumped the most this week off the backs of strength in energy, industrial metals, and even precious metals picked up a couple buy signals despite dropping a position. Not surprisingly, energy and basic materials right at the top of the rankings amongst the sectors. Industrials has lost a few buy signals, but nowhere near as many as communication services and technology in recent weeks. And then financials also been a big pullback we've seen in the last month or two. The biggest, I say, pullbacks in terms of number of buy signals have been tech, financials, and consumer cyclicals, which is not a surprise, obviously. Kind of working off what Joe talked about, this is crude oil as of, I think, 2 closes ago. This is when I think Dorsey Wright grabbed this chart before the price of oil on Sunday night, went from 118 back to like the 90s and then back to the 80s and then down to the 70s, and then it's resurged. I don't know where it's at right now, but it was back in the mid 80s. And so you're seeing a nice premium there. We'd been talking about the price of oil for a couple of months dating back to the fall, just how cheap it was getting, and not believing kind of a bottom was close to, or if not in. You can kind of see it here actually at $56. It bounced off this price level 4 times. That's why we were looking at energy stocks for a few months there, both in the natural gas and oil space. But just a strong resurgence. Dorsey Wright highlighted it was the highest weekly overbought, oversold for crude oil on their charting systems ever. Their data set, I think, goes back to the early 80s. So a really strong move. Obviously, there's people calling for oil to test its former highs back in the financial crisis era. But we'll have to see if that ever comes to fruition, or if this is a sustained war, if there's sustained shortages across the world and disruptions to supply chains, because apparently the Strait of Hormuz obviously seen a suspension in traffic there, really basically to a standstill. You can see from when the conflict started how many commercial ships were seen transiting the waterway. This is from a data vessel tracking company that Bloomberg utilizes, but we've seen a bit of a tick up recently compared to the early days of the conflict, and apparently they're all Iranian ships that are shipping oil to China, and they're turning off their GPS system. So if this continues, there could be an escalation, obviously, in the conflict, but there also could be potentially lower prices in the short term. There was also a massive reserve release, I think about 400 million barrels over the course of about 80, 90 days, I think, that the IEA announced. So there could be some reprieve in the short term, but prices moved higher on that just because it's the largest release ever, and it just shows how desperate countries are to tame the price of oil. And obviously the price of oil tied to a lot of industries. Bank of America ran this in their investment strategy newsletter this week, just talking about stagflation in the 70s, what the best returning asset classes were in every year from 69 to 81. You can see here. Obviously going to jump through them all, but strongest obviously being commodities for the most part, and inflation protected assets, but also predominantly gold. So I think we're still pretty weighted the way we want to be, especially with the fears of rising inflation, and with oil trading in the mid 80s and oil or gasoline for Canadians in the GTA trading closer to $1.60, $1.70. And across the United States, prediction seeing that $5 a gallon in the coming months, you're going to see a tick up in inflation, and it's really going to have an impact on the And then just quickly here, I think a couple more slides. This is just talking about energy, just the XLE ETF, just the surge we've seen to a new high, obviously amid this unrest. Heavily overbought, probably not a great point to enter just because you're buying it at such a premium right now. But if there is a bit of a pullback and a reversal, a really good entry point, I'd say. And then I actually showed this chart a couple weeks ago pre-conflict, and it was just talking about the reversal, the first really strong reversal we had seen for energy relative to the S&P 500. We did get a buy signal right before the conflict began. We got one buy signal back in the start of 2025, but we haven't seen a move of this magnitude since obviously 2022, or even before that in this massive move that we got out of COVID, when energy prices obviously boomed after oil went negative for a few days. So we could be on the precipice of an energy bull market relative to the S&P 500, and a lot of investors are obviously very underexposed. Now, two names here. These are not oil names, but two names we've been looking at even before this conflict began. Two U.S. names: EQT, one of the largest natural gas integrated companies in the U.S., obviously operating in Pennsylvania in the Appalachian, and then Kinder Morgan, North American midstream. Obviously do everything from infrastructure to exploration, but just two strong names. Dorsey rate charts look strong for both of these. We do own both of them, so obviously consult your financial advisor if you're looking at these two names. But just two strong examples of some setups in the energy space right now. Looking here quickly, this is just a different chart. We looked at a chart a couple weeks ago of conflicts in the performance of the S&P 500. And then other asset classes 6 months, 12 months, 18 months, and 24 months after these wars start. This looks at very short term, so 3 months, 6 months for treasuries, stocks, gold, oil, and copper. And you can see the returns here. Obviously, some could be outliers, I would say. But what it does paint is a commodity market in at least the short term. So hopefully you're weighted the proper way. Now, I'm just sharing this slide. I didn't know Joe was going to be going over that. I should have guessed just with our cash today position. But we did own Go Easy for a very long time, actually. We did get out of it in the past few months, and luckily we're out fully after this week's announcement of their growing loan losses, suspending their dividend, and even withdrawing their previous guidance. It all kind of stems from their early days when that short report came out, and then they've seen their CEO and CFO leave the company within 3 or 4 months. So I think that's a pretty troubling warning sign just for any public company, obviously. And then last one, just talking about gold miners. We always talk about this, but Franco-Nevada royalty play reported Tuesday night. Very strong chart here, obviously performed very well. But just to look at a couple of the numbers, revenue is up 86% year over year. Operating margin sitting at about 91%. And they did beat earnings estimates, and they did increase their guidance higher for 2026 and 7. Their dividend did increase. They've been on a bit of an acquisition spree because of their strong balance sheet. Obviously, this is more specific for Franco-Nevada, but not much debt, obviously, just a royalty compounder. Really a hedge against the decline in the dollar as they're paid in gold. And if you really look at the Franco chart, drastically outperform gold and gold mining indices since their IPO. So really a name I'd be potentially looking at.
And they used to do a fair percentage of energy too, so I'm sure there's some energy in there as well that they'll be getting a nice lift on. So some good, really good charts there. Can you share them with all of us? Just share your deck today, Ken. I'd like to be grabbing that one just showing the 60s and 70s that we talk about all the time.
Good morning, everyone, and welcome to this morning's brief update from March the 12th, 2026. My name is David Clark. I'm one of the analysts here at NASDAQ. Dorsey Wright. Mixed action for the indices we follow on the video here. We did see crude having another positive day, up about 4.5%, leading the broader commodity space higher. Did see the U.S. dollar along with emerging markets. Even the NASDAQ indices equal their way positive. Most other U.S. equity indexes in negative territory. Dow leading the way to the downside, down 61 basis points. And we actually saw gold down over 1% with yesterday's action. Now, looking at the chart of crude oil this morning, this being the 2-point per box chart, so a little more slower than the 1-point per box chart default there. And we did see a reverse higher up to 88 here after coming back down near the top of the trading band. Seemed to have found some support here in the upper 70s, around that $80 range, at least for the time being. That's what we'll monitor to see if that holds, or ultimately if that's violated, may change the tune of crude oil here a little bit. But keep an eye on that. As far as gold go, ultimately didn't see it reverse down into O's, still maintaining that column of excess support there at 50.50. And then ultimately we did see AGG reverse down into O's with yesterday's action, falling below 99.75 there, still maintaining a buy signal, currently holding support at that level. But this comes after a rally up to 101, and there's been pretty stiff resistance around that 100, 101 level for AGG for some time now. Now looking at the U.S. equities, we see the Dow reversing down into O's here, down to 47,200, putting in another lower top. Now monitoring that recent low of 46,800, along with we'll put a longer term line of demarcation there in the upper $45,000 range of 45,600, 45,800 for the Dow. As for other U.S. equity indexes, most continue to maintain their chart position that we saw them reverse back to earlier this week. NASDAQ 100 maintaining its current column of X's, technically traded slightly positive yesterday. From here, move about 25,200 to return it to a buy signal. We've really started to see this consolidation picture here, unlike where we've seen continued downside, another lower top for the Dow, so worth bearing in mind there. Now looking on to indicator action, we did see the 30-week for the NYSE move near that 50% mark, so another dip in stock trading above their 150-day moving average, but we still can say, at least for the time being, more than half maintain above that 50-day moving average. One will continue to monitor, but worth also bearing in mind that when we're looking at those stocks trading above their 50-day moving average, we see that set of reading sitting in the upper 30s. We did see the move below 40% on the TWNYSE following yesterday's action, but this is still above where we saw it dip down to in October and November of last year, and still well above where we ultimately fell down to in April. So just to provide some context there.Moving on to individual stocks, we do see HIMS up another 5% this morning after a strong day. Yeah,
that's interesting. So a lot of technical points there. Let me go. The morning coffee just came in, so let me go grab that. So just bear with me for 1 minute. Oh, great, it's actually giving me PDFs right out like that. Okay, so I can continue on here. Back to sharing. Okay, Michael Coolbaugh, his February results came in, another positive month, over 4%. So he continues to do a good job in the macro world, and his weekly observations did come in this week. And I've only just opened them, so bear with me while I go through them. Starts off with a gentleman named, no offense to Jeff Curry of Carlisle, but these guys only make the headlines with hyperbolic calls that are typically only made at turning points. Jeff was one of the many calling for $200 oil back in 2022, and no policy can stop crude's rise, even with the Middle East ceasefire. Jeff Curry. So he is a energy bull. S&P versus emerging markets. Investors flock to the safety of U.S. assets amidst the outbreak of war in the Middle East. Yeah, so that has had a bit of a overreaction there. Tech sector, tech software sector. The most popular short trade to start 2026 got squeezed as investors dealt with pain in their recent cyclical rotations. U.S. dollar index, I'll cover this with Dorsey Wright and Point and Figure. That's starting to notice a pattern. The most consensus trades to start 2026 were all unwound simultaneously. 2026 has been the year of degrossing. It's okay to let the dust settle. So I've been calling, or Dorsey Wright, Point and Figure has been calling for a rise in the US dollar spot index. The skew to the VIX ratio. VIX got quite panicky relative to skew on Monday. This ratio is already in fear territory before Monday, which is likely why it was so hard to sustain weakness. Now that vol has been monetized, we'll soon find out the real direction. Okay, a lot of jargon there. Okay, that's it. Quick with him. And just a quick look at performance to the end of yesterday. So you've got the venture exchange and Japan leading for the world, and then TSX venture, Canada up 4, all red in the US. So that's happened in the last week. Yeah, France, Germany have all gone negative. Italy, so they've been just killed in the last week. And India, of course, is continuing to have its challenges. Crude oil, we've already covered that quite a bit, so I don't need to do that, but very green, as nat gas is not too far behind it. Gold continues to, and silver continue to do well. Copper's come off a bit. I'll do our currency and interest rates on the Dorsey Wright side here. Okay, so Canada dollar versus the US has gone up to 74 now, and it's up a little bit, but its targets remain the same. On the short run, 78, and the long run, 62. This short run seems to be winning lately. Yeah, I don't know what's going on there with the US dollar spot index at 99 up to 103. It's been strengthening, as I showed you, so that should be actually putting weakness on our Canadian dollar. So hard to read our Canadian dollar and our Canadian politics, but we don't talk about those things here. Okay, there we are on the crude. So it's at 87 right now, measures down to 81. Nat gas 321 measured up to 460, so that's a change. And energy, the producers look to be flat. Copper off, uranium way off, gold way up. There's a 6,500 target for the futures, and London spot around flat. Whereas the producers, the large ones, tend to be ahead of themselves, as do the juniors. Silver measures way up, but the juniors down. So mix there. Bitcoin still has that target of 22,000. So whereas Ethereum measures up and Solana way up, and the index itself way up. So it doesn't make sense to me with Bitcoin being a major component of that, but who knows? Mixed information all the time. Here we are. The regional banks look like they've gotten ahead of themselves, as do the money center banks. So that's a change week over week. Our Canadian banks continue to look strong here. Okay, so let's get into interest rates, and then I'll pass it over to Sean. So nothing's really happened in the short end. 65 still measures down to the same 275. 5-year measures down, 10-year up, and the 30-year down. Although I've been noticing this 30-year has been trending. I chart it every day, and I've noticed it has been trending up of late. That's telling us something. Okay, that's probably enough for me. So, Sean, you want to take it away?
Yep.
Great, thanks.
All right, can everyone see the screen?
Yeah.
So return's not great over last week. I still have some of that residual exposure into some of these crypto positions. You know, the win on the oil trade was not enough to offset that. Allocated to copper, which was weaker. You know, we'll get into why. I think it's the growth outlook is being challenged, at least in the short term here. But you know, we have exposure to defense, silver, debasement trade, tech, and broad equities. Although we've brought that down recently. Our short, the Russell 2000 the back of oil and the war. Crypto market, what I'm known for, it's still broken. I just can't advise people to get involved at this point in time until we see some more constructive legislation and wars get into power and easing actually taking off. So big picture, I think the elections and tax refunds are holding up the equity market. Seeing still, this rotation has come out of the Mag 7 into the broader S&P, and now it's going back. I think people see the Mag 7 as potentially safer than exposure to the broad economy. Money's got to go somewhere every single day. Just think about globally. Money comes off of paychecks to go into retirement savings every single day, and that has to go somewhere. They're putting it into the Mag 7. I thought we'd see more of a rally in short-term debt instruments, and we're just not seeing it. So oil is now priced for war. Can it get worse? It sure can get a lot worse. We'll talk about that in a little bit. There's still, the whole tariff issue is kind of taking a big back seat right now. The yen carry trade, watch this space. Like we're up at like 158, 159 on the yen. And this is where the Japanese central bank has intervened in the past. And we're talking about like potential moves of like 5, 6, 7% down. So I'm looking at that. Am I going to put a trade on? If I do it, it's going to be via an option. Investment themes, like everything right now is about war, right? If they can't sort this Strait of Hormuz out, oil is just going to get more expensive. That's a global tax on the world. Asset classes, this is surprisingly calm for what's going on. Brent crude, up 10%. The world price of oil is represented by Brent more than West Texas. And for the week that we've gone through, these moves are staggeringly quiet. Everyone thinks that this is going to be like a quasi-Venezuela operation. We're talking about a country of 90 million people with an incredible coastline and a physical shipping pinch point. This is going to be a mess at best, in my opinion. Not much has changed in economics except growth, right? Like we had 5.4% projected growth by the Atlanta nowcasting. That's now fallen to 2.1%. That's dramatically different. I knew that 5.4 was too much. I put on the big 2-year position, expecting this trend down in growth. We've got it, and yet the 2-year just really hasn't been the place to be. We took that off a little while ago. I'm thinking about what happens now, because with oil prices up 50% in a couple of months, and we could see them up 100% at some point here, the risk of a recession goes up materially when you look at that type of a change in oil. The US dollar is stronger. We're seeing a flight to quality. Not much to say there. Longer term, it is the administrative position for a weaker dollar. Gold has benefited from the weak dollar and the rotation out of US assets by some of the emerging markets like China. It's just the strongest trend right now. The trend is your friend. We haven't seen price action that would precipitate another move in margins by the CME. And we're seeing that reflected in silver as well. The trend up is not parabolic anymore, but I do expect it to have a strong month, with it becoming more of a delivery mechanism than it ever has in the past. Oil, just, what a difference a week makes. We saw it blow past 110 on a Sunday night. What's been done since? A lot of talk, right? A lot of talk. Oh, we're going to secure the Strait of Hormuz. Just now, the new leader in Iran has said, we want to keep that strait closed, right? It's tough to tell what's going on there because the ships that are going through are turning off their transponders because they don't want to be targeted. Now, out of the 21 miles or so of the Strait of Hormuz, only 11 is apparently navigable. There's a 3-kilometer wide inbound lane, a 3 kilometer wide outbound lane. They're separated by a buffer. It is a pretty tight choke point, as everyone said. Like, this is going to be tougher than everyone thinks. We're talking about a shoreline that has a big mountain, not huge mountains, but has a mountain range around it, a lot of places to hide, and it only takes one hit to disrupt things. And 2 Iraqi-laden oil ships have been set on fire. I'm expecting that to continue. And these things are easily reachable by even the cheapest of drones. Longer term, I do expect a pretty material drop in oil prices from here. Rates and credit, really boring still. Really not much is going on. The U.S. mortgage rate ticked up a little bit. Credit spreads are basically where they were last week. But, keep watching the space. The private credit market is under a lot of pressure, and a lot of that's due to lending to software-related companies. But we're hearing about more funds gating redemptions. Equity, we've gone from fear to extreme fear in sentiment. As Ken mentioned earlier, our trend measures are weaker across the board. This price resistance at 7,000 has been there now for a couple of months. The rotation that we were hoping would broaden out to equity participation is kind of stalled. The VIX term structure is now deeply inverted, and that's a big warning sign in the short term. Positive earnings still overall. Oracle came out okay. So just not a great time to be an equity investor, right? Like, this is approaching kind of like a Sharpe ratio 0 environment, or you're just not getting paid a lot to bear volatility yet. We can see the VIX curve, the blue line is inverted, not what you want to see. That's not a huge inversion yet. Like, for what's going on, the VIX at 25 is actually shockingly calm. The S&P 500, when we look at a volume at price picture, you look up at the top right, you can just see, like, we've got this big stack of volume literally since last November, where we're just in this range. 6,800 to 7,000, we're just stuck there. The heat maps are showing a lot of red. Those are, when it goes to red, that's the threshold where constructive trends are no longer observed. And we're seeing that across our long-standing heat map, our new trend map. And at the bottom, you can see it's a very mixed picture with the different types of breadth measures that we've created. And the big question is, does the Iran war end soon? Crypto, it's a little better, but if there's anything positive happening, it's still very early. I consider it a broken risk asset at this point. My projection of downside is to 45,000 into the fall of 2026. We just need more clarity, which is in process. We'll see in April whether the U.S. legislation gets through. Trump is definitely, wants to see this done. So is there going to be a Bitcoin breakout? I don't know. Like, I'd really want to see it move up into the 90,000 range with like positive legislative support behind it before I'm going to get very bullish. This can kind of go either way. If you like bases, we formed another base, but if you look at the chart, we kind of had 3 sideways basing periods followed by significant declines. And that's the one thing with this asset. We see massive leverage occur from time to time in offshore markets that result in big sell-offs. And I can say that the institutional market is wary of this asset class. Again, we're in the 4th year of a 4-year cycle. Traditionally has just been terrible for Bitcoin. People say that it's different this time, but so far it has not proven to be different this time. The recent trade that we did in oil, where we had call options, worked out with over 100% return on those positions. But sadly, just didn't do a great job managing the exit. We could have made 2 to 5 times, but that's hindsight. But it led me to take a look at what I could have done better. I've learned about this strategy called convexity stacking. Some of these deep out of the money calls, when oil was pre-invasion, some of the 100 call options went up over 100 times, not 100%, 100 times. And then so there is a strategy called convexity stacking that more sophisticated hedge funds do, which I've deep dived in on, which is forming a matrix of out of the money calls by tenor. Looking to implement this on a monitoring basis. It doesn't happen frequently, but when it does, the potential returns are measured in multiples, not in percentages. And here's the cartoon for the week. I just realized, like talking to some of these younger analysts, like they've never been in a real bear market, like 2007, 2000. Like they cannot fathom what it's going to be like when we're down 20%, 30%, 40%. The tariff tantrum for them was just like a little short-term thing. It was another buy the dip. And it's going to really be something to see these younger people get educated when perception in a market changes. And I believe it's going to change first in some of the valuation multiples, and that can come out of growth. That could come out of expectations for a prolonged war. And then the oil impact could flow through and start impacting earnings, decreasing margins, hitting the consumer and reducing spending. So that's it for me. Gilbert, do you want to take it from here?
Okay. All right, this is the short report for Thursday, March 12, 2026. Here's the disclaimer here. S&P 500, again, still staying in this range here that we're going to take a look at a bit more closely in just 1 second. The reason why I've got this this support line here is because this has essentially been the low. So if the trend does break in any sort of material way, going back to 2009, I mean, we've seen that this is essentially where we should expect to go, which is almost 25% below where we are right now, which effectively is a bear market. So as Sean pointed out, not a lot of people have been through that, and so if we do get a break, this is what we can expect. Looking closer at the S&P 500, again, we've got this sideways action essentially since October. And we now look to be possibly rolling over. There are a number of factors here that could play a role in determining that, but one of the main ones, I think, is just valuations. Taking a look at the CAPE ratio, we can see the CAPE ratio is actually starting to roll over here a little bit, similar to how it did at the start of 2025, but more actually importantly, is similar to how it did at the start of 2022. Or to see this break, then we could see much lower valuations from here. Credit spreads, once again, I'm pounding the table about credit spreads because every time credit spreads get this narrow, we typically have some sort of volatility event that results in price moving lower in the S&P 500, whether that's the tariff tantrum or the 2022 sell-off. Defense versus growth, we can see that we've had a little bit of a rotation back into growth after this big move into defense. However, we similarly saw that in 2025 and also 2022. So it does not mean that this move is over. Market breadth, I had previously pointed out here that this level at 70% of stocks trading above their 200-day exponential moving average is essentially a limit for this move, and we've seen a pullback since then. What we're looking for, I think, in terms of a low would be this red band at the bottom here, which has been the low back to 2018, 2020, 2022, even in 2025. And so to catch a low effectively would bring us back to that level. One chart that I want to point out here, I'm not sure if I can actually get this on the screen here. This is oil in the S&P 500. So this is just sort of, back of the napkin type of stuff. But what I've noticed here, if you go back, so the top chart there is crude oil, right? And the bottom chart is the S&P 500. Every time we've seen crude oil go from under $70 a barrel to over $70 a barrel, what we've seen is a material decline in the market, whether it's 08, 2011, 2018, 2020, 2022. Every single time we've seen oil go from that level to above it, we've seen a pullback in the market. And I think one of the reasons why is what's been discussed on this call, which is elevated energy costs, essentially a tax on everybody. We get margin compression, less spending in other parts of the economy, and unfortunately also higher CPI. And that's going to put the Fed in a tough position because we're starting to see U.S. unemployment start to decline here. This was the number that came out. Again, another negative reading. This is, I think, the fourth one in the last 8 readings. So we're now averaging no job growth in the U.S. And as a result, the Fed is going to be stuck between higher energy prices, which is going to mean higher CPI, but also a deteriorating U.S. labor market. What could that mean? Well, it could mean that the market needs some time to breathe and it needs to take a rest. And given everything that we've outlined here, I think it's not out of the question that there could be an inevitable pullback here. And if you are interested in a solution for that, we do have a solution with our partners at Universa. So let us know if you're interested, if you're watching on YouTube. But that's it for us. Actually, that's it for me. Excuse me. Paul, I think you're on the call here. Do you want to take over?
Yeah, thanks, Gilbert. Sorry, my access got cut off there, so I had to re-enter. So I missed the end of Sean's and his cartoon. So Sean, send me your deck as well. Beetler, go ahead.
Yeah, hey guys, can you hear me? Is Mike's working? Yeah. Well, what can I say? We're stock picking within this market, and I think that's going to work out fine. I kind of agree with you. The markets, Gilbert. I mean, the markets are, especially the U.S. markets, are look like it's been flat. In fact, the Nasdaq's been flat now for 7 months. So you're not making any money owning the index, and they look a little tired. But stocks within the markets, we're finding all sorts of stuff. We have 45% of our portfolio now trades at under 4 times EBITDA. So we think that's extraordinary value. There's value all over the place, particularly in the energy sector. So you just buy these cheap stocks. Oil came out with their numbers this morning, and they're trading at 3.2 times EBITDA. And stock's up 10%. Well, no kidding. Anything's trading around 3 times EBITDA, it shouldn't be a public company, right? So interest, Parex, like we're looking for energy trades, but energy trades that are going to work basically, even if this all cools down the next month or two and oil retraces $20. Parex just bought a company, one of our biggest holdings, just bought a company the same size as it, right? They paid $800 million, bought a company the exact same size as them. Well, they used to be at $2 billion valuation. So now this whole thing's going to about 4. The yield on Parex's stock is 7%. So, and that stock trades below 2 times EBITDA. So that's the Colombia oil and gas company. So we're moving that to our 4th largest position. We think this is just a fabulous deal in the market. There are only a couple of guys that cover it. It's a $4 billion company trading at 2 times EBITDA with a 7% yield and a strong balance sheet, and very few people cover it. So that's Canada for you. The stock's going much higher. We've heard and we believe and we think that Mr. Carney, our glorious Prime Minister, is going to continue to spend just enormous amounts of money, invest enormous amounts of money. He's going to give out contracts galore. So I think this is going to be like shocking because these contracts are going to be very, very substantial. So he's going to ratchet it up. This is money we don't have, by the way, in Canada. So he's borrowing the money and putting it into the economy. I don't think it's a great strategy at all, but I think that's what he's going to do. So we think the beneficiaries are anybody in the defense business in Canada, any Canadian company in the defense world. And our 2 favorites are MDA, right? The MDA Space, terrific company, and then Telsat. We think these guys are going to benefit from all of this, and we think stocks are going much higher. And MDA, interestingly enough, went and listed on the New York Stock Exchange yesterday. So it started trading for the first time ever in the U.S., and they raised $300 million or so, almost $500 million. They're now listed in the States. Apparently the deal was hugely oversubscribed, and it's trading at kind of deal price. So it's trading at today it's getting beaten up, but you can basically buy it just a little bit above deal price. So we love that company. So that's now our 2nd largest position. So there you go. Lots of resource stocks, and then lots of oil and gas stocks, and then you go with Canadian defense stories. And I think you're going to have an exceptional year for investment. And anyway, that's what we're doing.
What was the energy name at the beginning? I can't find it.
Well, there's that company, Soil is the symbol, Saturn Oil and Gas. And, but so that company's doing great. I mean, the numbers they announced their numbers last night. So SOIL, we own some of that. But the one we're pounding the table on now is this Parex, PXT.
Parex, that's what I couldn't.
Yeah, Parex, PAREX. We've owned this stock for like 15 years, in and out of it. But now it's a $4 billion company. It's going to produce like 85,000 barrels of oil per day. Good for these guys. It's not a small business. It's the largest independent energy company in Colombia, and it trades at a ridiculous value. 2 times EBITDA. Anyway, it's such a no-brainer because they're going to pay you to own the stock. They're going to pay you like 6.75% yield. So I don't know. I think it's good value, great value. So, and I guess the other area that we think is exceptional value, and we put it on our podcast, is that all these those silver companies, silver and gold companies that are going to restart operations within the next 18 months. That's where we've put like 20% of our fund into a whole slew of names. I think I sent you guys the comp sheet last week, and a lot of these companies are trading below 2 times forecasted cash flow. Some of them are trading at 1.1 times next year's cash flow. So silver companies that are restarting, and just like that AUMB we talked about a couple of months ago, right? They announced a restart of a gold mine in Manitoba. The stock goes from 25 cents to $1.50. So huge upside. So we like that story again as well, because they're going to restart this thing in the next 12 months. And that trades at a low cash flow multiple. So I think that's where you're going to make exceptional returns. And frankly, I really don't care what the rest of the stock market does, because these multiples are just way too low.
Okay, that's great. Very interesting. No Chris Curry today. And I think, is that it for everybody else?
I think so.
Okay, we'll talk to y'all later.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.